Jack, it's always good to have you on the show. So as an economist, how do you take the information about vaccines, fit it into an expectation or a projection for the economy right now? Is it possible? Does it have to stay just generally broad? What does it mean?
Sure. I mean, the vaccine news is fantastic for our health recovery, and we can look past, for example, the COVID pandemic as of the second half of next year. But we still have, spikes in infections and lockdowns and the potential for, problems between now and then. The other, of course, is while we can put the health effects behind us pretty quickly, and that's great news, there will be lingering economic impacts, most notably from a lot of the rent forbearance that we haven't really solved, a lot of the mortgage stuff. So we'll have to see how that ultimately plays out. So I'm encouraged by certainly the wider breadth and a lot of the pandemic losers now finally participating in the rally.
Jack, how do we think about what a post-vaccine trajectory for the U.S. will look like versus the rest of the world? I mean, everybody's still dealing with this to various degrees, but for the most part, everybody still is. We've seen curves go up just massively over the last month. And the U.S., for the economic bounce back, though, ours has been pretty quick. I mean, obviously still faster than a lot of economists expect. The V shape is still possible for a lot of different metrics. So in terms of what it means for us relative to others, how do we figure that out? Is it equally good for everybody, or is it particularly good in one area? I mean, how are we going to figure that out?
Yeah, I think a lot of it, Oliver, is going to depend on the distribution of the vaccine. As we know, it's not simple. We can't just simply put vials in envelopes and send them around the world. Here at home, we're lucky. We've got tens of millions, hundreds of millions of vials ready to go. That we can't say that necessarily for the developing world, for the poorer countries. I'm hopeful we'll be able to come up with a scheme to help bring them along. So I do think we're seeing we will see an economic rebound in the developed world pretty quickly, but it's still going to take probably past 2022 to get to economic levels that we had at the end of 2019.
So right now the dollar has been firming on these reports of vaccine progress, and I think it's pretty interesting, Jack, because for a long time everything good seemed to be dollar negative in this recovery. Fiscal stimulus, monetary stimulus, the overall pace of the recovery. Investors are taking money out of the dollar, putting it into work and risk assets, and it seems like maybe this is potentially changing that. Is there an obvious reason why? Should we expect now good economic news or vaccine news to actually be dollar firm? Because a lot of these relationships for investors have hinged around the dollar.
Yeah, I think that there are a couple of metrics that I track engaging where I think dollar should be. One, of course, is purchasing power parity. Good news is after a huge dollar strength and then the dollar weakness for most of the last year, dollar is actually back to still expensive, but much closer to fair value. So I think that's a good sign. The other, of course, is the relative real rates. Our rates are negative, but everyone else's rates are more negative. And so the capital is going to gravitate to currencies that have either a positive real rate or at least less negative real rate. And I think that benefits the U.S. right now. And of course, then economic recovery. The fact that we introduce a highly effective vaccine, the argument is we're likely going to be able to benefit from that first. That then cascades out to the rest of the world. That near-term dollar positive.
Okay, and that's really important to bring it back to that first question here, as the two are very much connected. The dollar is really where I was kind of going there. So I think that's important context that right now maybe a U.S.-specific recovery that can be expedited by virtue of this vaccine. Before then, of course, everybody else gets to take part in this. Might be some explanation for that firm dollar. In terms of other potential impulses here for the dollar, it seems like the Fed speakers, we got a bunch of them this week. They don't seem to be too eager to tell us anything that new, Jack, since Powell put us on cruise control, but stimulus is always still kind of a toss-up. We don't really know what's going to happen there. Do you have thoughts on what number would make a big difference? I mean, what type of information we could get from the policy side that might be a wild card here that investors aren't expecting, or is it going to be pretty much as expected?
I think it's going to be steady as she goes. They will likely implore legislators to try to enact fiscal policy. As we know, monetary policy now for the last 4 decades has been hugely stimulative. I point out that if you look at the return of the S&P for the last 10 years, cumulatively, the S&P is up 260 percentage points. Well, 160 percentage points of that move was PE expansion, valuation expansion, and that's directly tied to incrementally lower interest rates, particularly relative to inflation. How far can we go there? Unless the Fed wants to go into negative territory, which they said they don't, I think we have to take valuation expansion off the table, which means then that the S&P is now tied to earnings growth plus dividends growth. Well, we know dividend growth is around 2. Earnings growth, maybe around 3 or 4. So, we could be looking at an S&P 10-year outlook return of around 5 or 6. So I do think that investors do need to dial down their expectations. And in terms of this switch from growth to value, I'm not a huge believer. I think there's going to be certainly a value catch-up. We're seeing it now. I'm not convinced that value will now take the baton and lead us forward for the next 10 years. It just doesn't, the way our economy is set up, it doesn't appear that is likely to be the case.
Is that just because these are not the companies that have been generating big bottom line profitability, Jack? Is this a long sort of tech stance that you want to hold in? Because when you say valuation expansion being limited, that sounds a lot more difficult for tech and the growth stuff than it does any of the value category.
Well, yeah, I guess. I mean, you're right. Tech has certainly benefited from valuation expansion. They are certainly long duration equities. But on the other hand, if we now strip away valuation expansion altogether and rely almost exclusively on earnings growth and dividends, then we have to look at companies that have earnings growth and the techs and that has a higher organic rate of growth. And we also have to look at pricing power, and that tends to be the healthcares and the tech side, and not necessarily the cyclicals or the financials. So we're doing a little more work on this. I expect that value is going to certainly play some catch up here. But if we're really looking at just down and dirty organic accumulation of value, I think that I would rather go with higher organic growth with more pricing power, and that's generally the larger companies.
Jack, does that also bake in an assumption on rates? Do you have a potential for more of that kind of schism in the market between value and growth if rates do move quickly to the upside? Does that push you to then rethink the thesis if rates start moving higher? Or do you have a view on rates that can incorporate significantly higher yields and still be unconvinced about the potential for value come back?
Well, I do think that rates are undervalued. You guys were talking about copper before the break, and one of the things we track is the relationship between copper and gold. And it turns out that relationship has been a pretty good predictor of where the 10-year Treasury yield should be. If you think about copper being pro-cyclical, gold being defensive, and it turns out that our model suggests that the 10-year Treasury should be about 1.6, not 0.9. And this was, suggesting 0.9 about 2 months ago. So it's certainly moving in that direction. The question is, where does that growth come from? Or where do those rates come from? Is it real growth, or is it inflation? The Fed is hoping for some inflation because then they can keep real rates, negative and more negative by just keeping interest rates where they are. And that would be certainly good for valuation expansion. We'll see. I think probably the best thing for this market over the next couple of years would be just 2 to 2.5% inflation with rates staying where they are.